Great, thank you very much. Thank you to LabOne and IBFC, as well as the Malaysian Bar Council for inviting my participation here today. So the talk we're going to have will deal a little bit on the Malaysian implementation of the Common Reporting Standard. Now, I think from conversations that the CRS or Common Reporting Standard is not widely understood. So I will try to sort of expand a little bit more on what this is, because today's, the prepared slides don't go into the basis of the CRS in terrible detail. So I'll try and just flesh out by way of, extemporary example, what that's all about. Then we're going to get on to this new initiative, which is supposed to strengthen the CRS, which is this mandatory disclosure rules. And the mandatory disclosure rules are not yet in effect. They're not live yet. They are in the EU, but they're not outside of the EU yet. But they're designed to strengthen the CRS and to seek to dissuade people from trying to circumvent the reporting. So most of the presentation will be dealt with on the mandatory disclosure rules. Okay, so I'll just kind of summarize. So we'll deal a little bit with the CRS, the implementation update for Malaysia. And then we'll deal with the mandatory disclosure rules, which is an initiative that is coming. In the mandatory disclosure rules, it's really looking at how it works in practice, who will be affected by it, and some of the issues that it will raise, particularly when it comes to lawyers, legal privilege, and the rule against self-incrimination. So it brings up actually some fairly substantive issues for lawyers, going forward. You'll also see that it has they're attempting to make it retroactive in effect, which you'll have to consider for any constitutional lawyers here. You have to see whether or not it's possible to make retroactive legislation in Malaysia. So it's a major initiative, and it's something that hasn't yet been enacted at a domestic level, certainly not in Malaysia or Singapore or Hong Kong, but it's something that you need to be aware of because it's supplemental to the CRS initiative. CRS implementation update. Now this is just for Malaysia, okay? I think we'll just backtrack on the CRS and look at what it's trying to achieve internationally. So if we take as an example, we have Malaysia and we have partner jurisdictions, right? What the CRS is trying to achieve is a coupling together internationally of separate tax authorities. So the tax authority in Malaysia with its sister tax authorities around the world where we've partnered up, okay? Now the mechanism to achieve that is domestically we have financial institutions feeding information into the tax authorities, and the tax authorities are then connected up to try and grab hold of that information on an exchange basis. So how does it work? Well, we have a tax resident individual in Malaysia. So this is this gent here, and we have a reciprocal tax resident individual in a partner jurisdiction. The idea behind it is we've got each of these individuals here and here owning accounts in the reciprocal jurisdiction. So the Malaysian owns, let's say, a DBS account in Singapore, right? The idea behind this is that the tax authorities will exchange information on those account data on an annual basis automatically. So for the Malaysian individual holding an account in, let's say, Singapore, the information will be backtracked. CRS contains effectively 4 categories of financial institution that captures data for exchange purposes. So the obvious one is a bank. The others that are captured are things like an insurance company. And then we look at custodians. Trust companies can be obviously within that category. And then we have this rather odd area of the investment entity, which is a company or an entity that's professionally managed. It's effectively doing investments, but it's professionally managed either by an external asset manager or alternatively by a bank-provided asset manager. So you capture by each of these financial institutions being involved, or categories of financial institution being involved, you capture a significant segment of the financial services industry. And it's the financial services industry that's the first layer of collection of the financial account data, the information, and then it's leading on to the exchange of that information across border on an automatic basis. The innovation with the CRS is that before we had to rely on a treaty network to exchange this type of data. And there you'd have to typically show a cause, a reason why you needed the data. The CRS takes us to an automatic basis without any cause. So it's a habitual cycle of data every year. Now, Singapore and Malaysia are obviously in an exchange of information relationship, and the first information would have fired off probably on Monday of this week in terms of an exchange of data between the two countries. So if I run through, from Malaysia's perspective, Malaysia sends out data to 62 countries, and Malaysia receives information from 89 countries. There's a disparity because there's a timing issue, as well as some countries don't require data to be sent. So BVI would not require data to be sent to it. The UAE does not collect data. So they'll send data, but they won't collect it for various reasons, some of which is they just don't have the concept of income tax. So they don't need the data to verify a taxpayer's status. That's why you're seeing the discrepancy in the figure. Now, on the OECD portal, they have the current list of exchange relationships with Malaysia. So I'm only going to show in these slides, and there's 9 of them, the jurisdictions that will be sending information to Malaysia, okay? Because I figure that's probably more relevant. And you'll get a copy of the slides, so no need to worry about taking shots. So the important thing to do when you're looking at the portal, and as I say, the web address is on the presentation, so you can monitor this yourself, is it tells you the date on which the relevant bilateral arrangement has been activated. So let's choose an example, Andorra. Andorra was activated, so this is the top one here. Andorra was activated under the Multilateral Competent Authority Agreement, which is the umbrella sort of international agreement. And what it's saying is it's effective for tax periods commencing the 1st of January this year, which in effect means that the exchange with Andorra, the first exchange with Andorra, will happen next year, September, because CRS always reports in arrears. It doesn't do it on a current year basis. And you can flick through some of the others. With China, for instance, it's effective now, as of January of this year, and the first exchange with the Chinese tax authorities with respect to Chinese tax resident individuals holding accounts in Malaysia will be next year, September. The data point figure will be as at 31st of December of this year, all right? So CRS doesn't do an averaging, it just takes a one-day shot, and that's usually the 31st of December, okay? We can keep going through. I think one of the relevant ones is Kuwait at the bottom here. So the exchange actually will occur in 2020, and it will become effective in terms of the requirement for Malaysian financial institutions to garner the information on Kuwaiti tax resident individuals. That will commence next year, January. So the first exchange will be in 2020, September, okay? So it's always the following year, September, that they exchange the info. We go through it. I'll just find Singapore and all this. So Singapore is here, and Singapore is an activated relationship, which means, in effect, the information would have been sent with respect from the Singapore account held by a Malaysian tax resident. The information would have been sent on Monday to the Malaysian tax authorities, okay, for the first time. So what we're seeing in Asia at the moment is the very first exchanges internationally, yeah, because we're second wave adopters. We're not the first wave. Okay, and then finally, the last of this, going down to Vanuatu and Uruguay and the UK, all activated relationships. The web address is this. Don't take a shot. Don't worry, you'll get the slides. But this is where you'll find the portal. It gets updated quite often as countries begin the activation process. Okay, so you do well to, if you're having to monitor this, then do it on a regular basis, because countries come on all the time. Okay. So from a CRS perspective, the major element will be how is it that information is sent to Malaysia with respect to Malaysian tax resident individuals holding accounts internationally outside of Malaysia. Now, one thing to understand about the CRS is it does not have a tax effect. Okay? The figures that are sent back to Malaysia are not going to be used for any taxation purposes of themselves. All they are doing is effectively providing some level of surveillance for domestic account or domestic resident individuals holding international accounts. Where that information goes and what the use to which it's put is a completely another thing. So it's just effectively a surveillance device, a financial surveillance device. Obviously, the premise of this is that it's trying to stamp out tax evasion and underlying money laundering. Okay, so that's basically the CRS initiative. It's an exchange of financial account data on an annual basis without cause, without any particular reason. The mandatory disclosure rules. Now, this is designed specifically to strengthen the compliance with the CRS. Okay, so this is the new initiative launched by the OECD this year. The background to this is the G7 meeting in Bari in 2017. And in that meeting, they have a report and they have a statement of intent. And within that statement of intent is this direction by the G7 to the OECD, for the OECD to investigate the use of mandatory disclosure in order to strengthen the compliance with the CRS mechanism, because the OECD are aware that obviously there's a constituency that wants to avoid the CRS reporting, and there's a constituency of professional advisors that are happily involved in helping clients to avoid the CRS. So being aware of this, the OECD have been directed to look at mandatory disclosure. Now, mandatory disclosure is not new. It's been something that's been talked about during the BEPS project, so the Base Erosion Profit Shifting, which is a major overhaul of the international tax system. BEPS Action 12 deals with mandatory disclosure. So a lot of what the OECD have done for the CRS is based on this particular initiative. There was a consultation period leading up to the publication of the mandatory disclosure rules. You'll probably see the dates, 11th of December to 15th of January. So it was a very short period of consultation, and there was lots of criticism that it fell over the sort of Christian holidays as well. The results from this is about 150 pages worth. When it came to the contribution from Asian providers, there wasn't much. I think we only had one contribution from someone in Hong Kong. And I guess there's a number of reasons for that, but it just shows that these initiatives sometimes just completely go by without people being aware of them. So the major areas of feedback on this, and I think it's important when we're sort of talking to a group of lawyers and business professionals, because undoubtedly Malaysia will probably have a consultation period as well, I would have hoped, on this. But the major feedback was, why was it so short? Why such a short period of consultation? on an initiative that's this important, because these rules are quite radical. Another area of sort of criticism of this was, isn't it a bit premature to strengthen an initiative that's only just launched? So wouldn't you wait to play out to see whether or not it was actually weak, it was being exploited? So these are some valid reasons, coming back as to why to implement this initiative in the first place. Why not strengthen the CRS itself? Why bring in a completely different mechanism? Because usually where statutes are found to be weak, or they're not fit for purpose, you strengthen the statute. You don't bring in a different statute to sort of indirectly strengthen it. So it was a bit of an odd scenario. That's what was being highlighted. The legal professional privilege, legal advice privilege, is affected by this mandatory disclosure rules. And the way in which it's dealt with is a significant erosion of the right to privilege. Okay, so when I go through the slides, you'll see how they intend this mechanism to work. Retroactive in its effect, they're effectively trying to make the rules applicable from October 2014. So that would be before even Malaysia had CRS on the statute book. So we'll have to see how that works and whether or not it can actually be criminally retroactive. The way that they've drafted the provisions initially was quite pervasive. It almost made it effectively strict liability. So if there was a CRS non-reporting outcome, that would give rise to disclosure, regardless of the intention surrounding that non-reporting outcome. So this was an area of criticism. There was some attempt to try and address that. The standard of proof, or the intention standard, most of the respondents wanted it to stay with the current CRS level of a subjective intention, and they kept it at objective. So you'll see as I go through where that becomes relevant. There was no real attempt to interlink the two statutes, which seems a bit weird given that one's supposed to be, strengthening the other. So there was no sufficient interlinking between the CRS initiative, the CRS legislation, and this mandatory disclosure. So that was also criticized. And I think the basic takeaway was this appeared to be just simple mass surveillance. And we would have to see how, in effect, this would actually help the tax administrations around the world to strengthen the CRS, because it was so pervasive and untargeted. So I think these are sort of legitimate criticisms leveled at the initiative. Having said that, we had the mandatory disclosure rules enacted in this sort of report. These are all freely available on the OECD website, these documents. And then following on, we had the EU almost immediately implement, which was a surprise because I think everyone thought that this would take some bedding in. Maybe we'd wait for the peer review of CRS in 2019 going forwards. But the EU immediately stamped it and said, yes, we will adopt this, and they have by this directive. The key takeaway for the EU is they do not take the full retroactive period back to 2014. The EU have rejected that. What they have done, though, is from the date of publication of the directive, which is June this year, it's deemed to be effective retroactively, because directives have to be implemented domestically to be fully effective. So that's significant. It shows that the European Union wasn't really up for a retroactive piece of legislation. The timeline is member states have to implement by no later than 31st of December 2019, and then it has to be live by no later than 1st of July 2020. It's quite tight time periods as well. So the relevance of this is this gives a timeline for general adoption globally, because once the EU have implemented, then it becomes best practice. So we would have thought that participating jurisdictions in the CRS initiative will be under some pressure to implement on a similar timeline, particularly the offshore financial centers of Singapore and Hong Kong. When you read the directive, the language is a little bit more aggressive from the actual OECD standard level. However, the directive does contain a passage where it says that implementing jurisdictions may wish to follow the OECD lead rather than the EU directive. So the likelihood is that when countries get round to doing this in the EU, they will look to the OECD standard as the basis on which they'll do it, rather than the EU directive, given that they've been allowed to do that. So that's the sort of background to what's been going on here. It's G7 that has pushed this. The OECD have reacted with a very short consultation period, and now we've had it brought into effect and put into force in the EU. So if you have any EU sort of resident colleagues, they are already affected by this. So it's not a theoretical thing for them. It's an actual legislation that's in effect, particularly because it's retroactive, or at least effective from the date on which the directive was issued. So, how does this all work then? How does this mandatory disclosure actually work as a mechanism? What did the draftsman intend when they brought these things in? If you've not seen mandatory disclosure rules before, they tend to follow a similar approach, and this one's no exception. Basically, you have to have an arrangement, right? So that requires at least two parties to interact. And in this case, this is you as the professional, and this is your client here, right? And you're entering into an arrangement. That's what it requires. An arrangement is very broadly drafted. It doesn't have to be legally enforceable, okay? It can be just an agreement, an understanding. That arrangement leads to avoidance. And avoidance, it's very important to understand this point. Avoidance under this initiative doesn't lead to a CRS non-reporting outcome. That's not the requirement. It's much sooner than that. It's making available an arrangement to avoid, not the actual implementation of an avoidance. This legislation is not looking for an outcome, okay? Once you have avoidance, you then have a disclosure obligation. This disclosure obligation rests with you, the professional, the intermediary. The time period is 30 days. It had been 15 days on the consultation, so this is a concession. All right? Under the CRS, you basically have a year to work out what's happened. And usually everyone will, scrabble around in April of each year to figure out what happened in the prior year. If you've been doing it that way on the CRS, if you're responsible for CRS reporting, you won't be able to do it that way with mandatory disclosure. You've got a 30-day turnaround period, right? Now, I've used in terms of where the information goes, the disclosure is then made internationally. It's not just a disclosure to your local tax authority. The disclosure is also made exchangeable with international participating tax authorities. I've just shown the China tax authority as an example, okay? But the information on the avoidance arrangement, if it involves, let's say, a China tax resident client, will be made available to the China tax authority as an exchanged information. We're not quite sure what the period will be, whether or not it's an annual exchange or quarterly or on the 30-day cycle as and when. Not sure how that will end up being. Once we have the exchanges with the tax authorities, then obviously they're aware of the arrangement. And they can then decide whether or not they want to get in touch with either the relevant client or alternatively get in touch with you. Now, The worrying aspect here is whether or not the foreign tax authorities will actually become aware of you. And what I mean by that is, let's say you're a relationship manager that spends your time flying from KL to Beijing, talking with clients there, and the discussions that you have give rise to a number of CRS reports or mandatory disclosure reports on the CRS Avoidance Arrangements. So these are the reports that are going up to the tax authorities in, let's say, Beijing, and it mentions your name over and over again as someone who's habitually flying in promoting these schemes. The aspect that's worrying here is whether or not at some point you're going to be taken to one side at the airport. Yeah? So we don't know whether or not it's the financial institution or the intermediary institution that will be disclosed, or it's more granular down to the name of the individual that's involved. Yeah? If it's the name of the individual and you are habitually flying around doing private wealth business, then yeah, it may be something that might be difficult, because mandatory disclosure is not criminal of itself. There's no, there's an emotive element to it for sure, but it's not criminal to have a mandatory disclosure report. But tax authorities around the world may take different views on these arrangements being made with their domestic taxpayers. So please bear that in mind when it comes time for the implementation in Malaysia. You might want to get to the bottom of who is actually being reported here. Is it the organization or the individuals? All right, now with respect to the intermediary, this is looking at the professionals. You can be one of two types for this initiative. You can either be a promoter or you can be a service provider. You can be both sequentially, right? But there's separate treatment for each, promoter and service provider. Now, for a promoter is someone that's responsible for the design or the marketing, of a CRS avoidance arrangement. So designing or marketing, and I'll come on to the commentary on what they think those terms mean when you're trying to sort of figure it out. For service providers, it's a bit jumbled up in the language, but basically what they're saying, if you're a service provider, if you provide assistance or advice in respect of the design, marketing, implementation, or organization. So this would catch trust companies that are administering a structure which is as a result of a avoidance arrangement. So it's quite a wide net on the business professional side. It's if you're promoting, designing, or marketing, or it's if you're assisting, providing relevant services too. We'll go in more detail when we iterate again on this. For the clients, so these are your clients here. There's two types. There's a client, and then there's this reportable taxpayer. The difference between the two is, for a client, this is a person that requests the CRS avoidance arrangement or the relevant services to be provided to that arrangement. Whereas with a reportable taxpayer, this is someone that is either actually using or potentially could use. So the example would be, let's say we're creating a trust in the context of an avoidance arrangement. Let's say the settlor is your client, and then you have, let's say, a protector or beneficiaries. Settlor would be your client, protector and beneficiaries would be effectively reportable taxpayers, people that are using the arrangement. That's how you would break that up. So it's quite wide, the net that they want to capture of reportable persons that are involved on the client side. In terms of the avoidance, they use these concepts of generic hallmarks and specific hallmarks. Most mandatory disclosure legislation will have this terminology of a hallmark, right? I don't think we've seen this wording before. We haven't seen it in tax legislation, I don't think, and I don't think we've seen it before in anti-avoidance legislation, but these are new concepts that we'll have to get used to. It's the use of the word hallmark. The generic hallmark is basically the test that has to be applied as to whether or not there's an avoidance arrangement. The specific hallmarks are just instances of the types of arrangements that would satisfy the generic arrangement of an avoidance. Yeah? Because you find your fact pattern intersecting with one of these specific hallmarks, it doesn't mean that you necessarily have to report. You still have to do the entire statutory test. Yeah? So it's just an instance of where the OECD are aware of known schemes to avoid the CRS reporting. So they're just highlighting it for effectively enhanced due diligence on your side. Now, with respect to promoters, okay, promoters of avoidance arrangements, the idea is you have a retroactive period that applies only to promoters. And that retroactive period is 29th of October 2014 until the date your country implements the mandatory disclosure. Thereafter, you as promoter you'd have 180 days to disclose any schemes that you promoted in that period from October 14 until your country implemented. Yeah? So obviously the issue here is what's the constitutionality of that type of provision going forward. We saw that the EU didn't go for it. But this is the level at which the OECD wish countries to consider the implementation period. It's only for promoters. Okay, the actual wording is in Rule 2.7 of the mandatory disclosure rules. And what it says there is it doesn't apply to high value, there's a cutoff point for low value accounts. So anything above $1 million is effectively reportable if you are engaged in an arrangement. But a low value account below $1 million is not subject to mandatory disclosure. Yeah. I know from a Singapore perspective that you can't bring in retroactive criminal statutes under the Singapore Constitution. As we've got a room of lawyers, is that the same in Malaysia, that you can't bring in retroactive? Is any constitutional lawyers here? Okay, well you'd need to look at that when Malaysia comes time for it to implement, because it might be one of the areas on consultation that you would have to feed back in. Now, the fact that you can't bring in a retroactive criminal statute doesn't mean that the regulator or the tax authority can't find other ways to penalize individuals that were promoting arrangements to avoid CRS during the retroactive period. From the OECD's perspective, they've suggested a number of ways that countries can enforce these rules, one of which would be to name and shame individuals in the Gazette. Yeah. Another way would be, if you're a regulated person, to take away your fit and proper person test, so to affect your livelihood in that way. So it doesn't have to be that you are criminally prosecuted for doing this type of arrangement, even when Malaysia hadn't even implemented the CRS, let alone mandatory disclosures. So this is quite an important aspect when it comes time for domestic implementation, the mandatory look back, whether or not Malaysia would take it. Okay, so we look a little bit more detail now at promoters and look at the hallmark. So we look at the generic hallmark, and I know that the text is quite small for people at the back, but broadly what we're saying is, for a generic hallmark, which is basically the statutory test, CRS avoidance arrangement is any arrangement, it's reasonable to conclude, that's your objective standard, designed to, marketed as, circumventing CRS legislation, right? So the use of the word designed as and marketed. So you're looking at a promoter designing and marketing a avoidance arrangement. So as I said, arrangements are anything, whether or not legally enforceable. And designing, this is the wording from the commentary to the mandatory disclosure rules. To design a CRS avoidance is basically to do this. An arrangement should be treated as designed to circumvent CRS legislation if it is reasonable to conclude that it has been put in place deliberately to facilitate a non-reporting outcome. So that's the question of, if you look at your transactions in your files, if you are involved in advising clients on their CRS obligations, whether or not there was a transaction or any arrangement from the file where the only conclusion can be that it was to avoid the CRS reportability of that individual. If there was some commercial reason and CRS wasn't even mentioned, then obviously that test is not being met. It wasn't designed to circumvent anything. It was designed for commercial purposes, quite separately from the CRS. Yeah. The intention test here is quite tough because the standard is that of a professional advisor with full understanding of the terms and consequences of the arrangement. So it's not your subjective understanding. The standard that you have to effectively discharge is that of a, as they say, professional advisor with full knowledge. So operationally, if you're reviewing your files, that's quite a difficult one to implement because it means that you have to have a third-party professional sat alongside supervising your review. So if there is, a sort of, you have been involved in CRS advisory work in the preceding years, it's going to put a lot of, and Malaysia implement on a retroactive basis, it's going to put a lot of pressure on you to review your files to see whether or not we actually were involved in promotion on an objective basis. Very difficult. For marketing, it's a lot more simple. Basically, something is marketed as avoidance where the arrangement should be treated as marketed if the benefit of non-reporting under the CRS is used to promote or sell the arrangement. Yeah, so if you're suggesting a sort of structure so clients can habitually use this structure to avoid their reportability, let's say to avoid the reportability of their accounts in Singapore. So you do this structure, maybe take Singapore PR and then use that as a way to effectively try to establish Singapore tax residency. And you go out and market this habitually on email or on your website, or that's not a good deal, right? That would be marketing an avoidance arrangement. Yeah. So that's if you're effectively a promoter. The specific hallmarks, and I won't spend too long on this stuff, but the legislation contains instances of known avoidance sort of arrangements, right? So the first one that they give on these specific hallmarks is where you're using financial instruments or financial investments that don't constitute a financial account. So let's just say that you have a Malaysian tax resident individual that has accounts at DBS in Singapore, and they're concerned about the reportability of those accounts. And then you suggest, well, why don't you close those accounts and put it into cryptocurrency? Or we put it into a form of derivative contract, which is a non-financial account for CRS purposes. If you're using those sorts of non-financial instruments or financial asset instruments as a way to circumvent the CRS, then this effective specific head is telling you that they're aware of it and that you would need to look and put enhanced due diligence on this to make sure that you didn't fall within the test. The other one that they use is where you transfer or you suggest transferring assets outside of a CRS reportable jurisdiction. So why don't you close your accounts in Singapore and transfer it to Thailand? Or alternatively, why don't you send it to Taiwan? Or better yet, why not send it to the US? Yeah? So these are all tactics that they're aware of to try and stop the reportability of the accounts by shutting down the ability of financial institutions to report. The reason why is Thailand isn't implemented. Taiwan will implement, but they may struggle to agree exchange relationships, and the US has indicated it will not adopt the CRS. Yeah? Now, the other head that they use is where you deliberately use mechanisms to undermine the CRS due diligence process. And here what they're talking about effectively is the use of second residencies to try and fool the financial institutions into seeing you as perhaps being tax resident in Malta, or tax resident in Cyprus, or tax resident in the UAE, when in fact you're not tax resident there. So this is the perception from the OECD, is that this is an area of abuse. And they brought out a consultation on the abuse of residency by investment, or RBI schemes, or citizenship by investment, CBI schemes. This consultation basically had a number of sort of key highlights. I think the main one is what they consider, the OECD considered to be high-risk jurisdictions for these residency by investment schemes. And they set out the tests. So if a jurisdiction meets all of this, then the OECD would consider that jurisdiction to be high risk for individuals going to the jurisdiction, getting ostensible residency, and then representing themselves to their home jurisdiction, or the jurisdictions where they have accounts, that they're resident in these jurisdictions, to avoid the reporting going back, let's say, to Malaysia. Yeah? So one is no or limited physical presence required, low tax or no tax at all, exempt foreign source income, usually a special tax regime for the investment schemes. The jurisdiction doesn't receive any CRS data, and there's no absence of mitigating factors surrounding. So yeah, I was in Dubai a couple of days ago, and we went through this test as it applies to Dubai. And we found that in Dubai, you can keep your residency stamp if you spend at least 1 day every 6 months in Dubai. Dubai does not have the concept of tax, income tax. So therefore, it does exempt foreign source. There's no special tax treatment for RBI schemes because there's no tax. Dubai does not receive, or UAE does not receive CRS data because they've opted out of receiving it because they don't have a concept of tax. But however, the UAE does spontaneously exchange information with other jurisdictions, notably Pakistan. But unfortunately for the UAE, they would kind of meet a number of these tests, 5 of them. So of course they're particularly worried about this being highlighted as a high-risk jurisdiction for CRS avoidance. In terms of the consultation feedback, we had a number of comments, and the OECD then said this, that they would consult in May of this year to then come out with further strengthening rules on the abuse of residency by investment schemes. Nothing was heard. We had The Economist on Friday, this week's Economist, contains a number of articles on the abuse of residency schemes. You probably thought it was something more exciting, but it isn't. They highlight here on the particular mention of Dubai, and here where you see is the head of the OECD setting out what looks like it's on its way, which is basically here on the section. What's being said is it looks like a strengthening of the CRS rules. So if you've got an individual that has, let's say, a Dubai stamp in their passport, or if you're looking at it from a Hong Kong perspective, mainlander with a Hong Kong ID card, and that's been used to establish tax residency, then what you're going to find is the enhancement of these procedures to try and capture people that have so far got away with misdirecting their CRS reporting. Yeah. So we don't know when they're actually going to come back with the suggestions, the amendments, but it looks like from what's being said in this response to The Economist that the response will be a strengthening of the due diligence process on the CRS to make sure that if you have misrepresented that you are tax resident in Singapore and not Malaysia, that there's going to be a way of capturing that on another round of due diligence, okay? So there's other areas of heads of abuse, and you can go through these. As I say, they're just indicators of areas of abuse. Some of them deal with technical bits in the CRS, like the use of what they call active NFEs, which are companies or entities that are trading, and so therefore you're not entitled to identify who owns them under the CRS, so there's been misuse of that. And then technical misuse of trust distributions, where instead of giving a distribution in cash, you give it in kind, and that can avoid a CRS report on beneficiaries. So these are all the specific hallmarks. These may well be amended from time to time going forward as the OECD become aware of other areas of abuse. One technicality that comes up, it was something I mentioned at the beginning, was what if you don't have someone designing or marketing an avoidance, but it results anyway in a CRS outcome? The very simple version of this is, what if a client closes a reportable account? So clearly, closing an account means there's no longer reporting because it doesn't exist anymore. Is that enough to give rise to a report? There's no design, so there's no attempt to effectively close the account because of the CRS outcome. And there's no marketing of close your account and there'll be no CRS reporting. So this was a big area on the consultation. The question being asked was it enough for there to be no CRS reporting, a non-CRS reporting outcome? And initially, so it looked like this. There's no design, but there is a CRS non-reporting outcome. On the consultation, this was an area that was highlighted significantly, and the OECD then amended the rules to put this in place. They said an arrangement is not considered to circumvent CRS solely because it results in non-reporting, provided that it's reasonable to conclude that it does not undermine the policy intent of the CRS. So the problem with this stuff is it gets very, very technical to actually understand what they're talking about, because the drafting here is almost as if I was saying to a member earlier, it's as if they're just talking to a specialist lawyer now. It's like lawyer-to-lawyer discussion where, financial institutions around the world have to implement this stuff. The policy intent of the CRS is not explained. So the way that I would see it is, if there is an account closure and there's no more CRS reporting, and there's no prior design or marketing to achieve that, then that's it. There's no undermining of the policy intent. But it's very difficult, and this legislation that they're bringing in, it's very, very technical. Clients will need a lot of assistance to understand this. And obviously financial institutions to operationalize it will need a lot of assistance as well. I've tried to make it as accessible as possible, but I struggle when I get to this point because it is quite technical. And I'm a lawyer, so that, just be aware, it's they have this sort of caveat in there that just having an account closed is not enough unless it undermines the CRS, whatever that means. For service providers, important point to note is service provider can provide services alongside a promoter, or they can provide services to the promoter, right? They can come in many different ways. So let's say the service provider is Big Four accounting, providing services to a bank in designing a product that could undermine the CRS reporting. Key thing for a service provider is the provision of relevant services. Now, relevant services, as I said, was the assistance or advice in respect of the design, marketing, or implementation of an avoidance arrangement. It's assistance and advice. The intention test for a service provider is not as harsh as for a promoter, okay? Effectively, the intention test is, what do you know? What do you subjectively know? And what ought you to know given your professional standing and the services that you're providing? So it's calibrated to your standing, your professional standing, as well as what you actually understand with respect to the arrangement. Yeah? So it's not like the promoter where it's fully objective. What would an external party understand? This is calibrated to what did you know? You know? So it's a lesser test. In terms of the disclosure obligations, I'll run through the geographic scope of the obligation. When in the conversation do you trigger a disclosure? When does it happen? So when does your 30 days commence? What is reported? And the whole issue around privilege, and when does the client need to do it? So this is important for the lawyers here. In terms of geographic scope, the best way to describe this is as a matrix. You probably won't see the wording, but this is a permanent establishment. This is tax residency, and this is place of incorporation. And this is the intermediary as, let's say, a company. If you make available a avoidance arrangement, let's say this is the client here in jurisdiction X, what they are saying in the rules is every jurisdiction in which you have a connection, permanent establishment, residency, as well as place of incorporation, you should file a report in every single jurisdiction that you have a nexus. Okay? It's a very, very wide obligation. But they bring it back so that there's not multiple reporting. So they bring it back by effectively saying, if you didn't make the arrangement with this client through your permanent establishment, then there's no need to report. Likewise, if you do exchange information on the disclosure basis with the jurisdiction, let's say through your place of tax residency, then that's the only thing you need to do. There's no multiple reporting. I think the key takeaway here is if you are a service provider that, let's say, is incorporated in the BVI but operating tax resident in Malaysia, you've got a high level of, you have a high likelihood of multiple reporting unless you can get out of one of these exemptions. So in terms of service providers that are multi-jurisdiction spread, it's not a good idea going forward. If you're in the same jurisdiction and you don't have a permanent establishment anywhere else, that's fine, you don't have to care about this. Trigger date. So when is it in the conversation that you have to disclose the avoidance arrangement? Basically, it's this. It's when you communicate the arrangement to your client. So as I said at the beginning, they're not looking for an outcome here. They're just looking at when did you communicate the avoidance arrangement to your client. So when did you press go on the, or send on the email, or when did you say it in the meeting? That's when the 30 days will commence. In other words, we're not looking to see if the client later implements the avoidance arrangement that you suggested. Yeah? Who and what is reported? So let's assume this is you as the intermediary. You report your client and anybody that you know is using the arrangement. And you also report all of the intermediaries that you have joined with in providing the service. So it could be lawyer, accountant, fiduciary company, private banker, external asset manager. So it's very wide on who you should co-report. Remember, in terms of the reporting cycle, it's 30 days. And if it's the retroactive, it's 180 days from the date on which Malaysia implements. So there are different time periods for your reporting. Now, let's just get on to the sort of last bit, which is how it will interact with privilege. So let's say that we have you're based here in Malaysia, and this is your client. Let's say that client's based in China. And you provide advice to that client, and you should report that advice to the Malaysian tax authority in 30 days, because the advice, let's say, was tantamount to an avoidance arrangement. If you are legal counsel, it's privileged, and therefore you do not have to report. Okay? Legally privileged conversations under a mandatory disclosure. But what the rules provide is that effectively your client has to make that disclosure. I'll do it all this way. So your client takes on the obligation to report where you don't report or any other intermediary. So where no intermediary is reporting, the rules say that the client has to report. Now this is quite significant erosion of the privilege that's usually conferred on attorney clients. Yeah, it basically is trying to circumvent the privilege. Question comes up is, if your client is going to disclose, can they effectively hold back from disclosing if it would self-incriminate, if it's effectively going to be a confession for a criminal offense? Not much said in the rules on this, on the self-incrimination head, and there's not much said about the Malaysian intermediary, not the lawyer here, but the intermediary, disclosing where it could be self-harming insofar as a criminal offence. Yeah? The only thing that's said on mandatory disclosure is disclosure by a taxpayer is not required where disclosure would be limited by domestic protections against self-incrimination. But they don't say anything about the intermediaries. Yeah? So you'd be falling back on your general, I suppose, common law rules here against self-incrimination. Under the BEPS project, they have a whole annex dealing with this, and the way that they deal with it is they say countries may, in effect, not have any disclosure obligation where it could lead to a criminal prosecution, or in effect, they wouldn't use it in evidence against the individual. The key thing here is you probably, when this is implemented, unless Malaysia actually sets out clearly what is the relationship between self-incrimination and mandatory disclosure, you might want to sit with criminal attorney and work out what should we be saying if there is some underlying criminality. Yeah? The issue here is really about, was there a suspicious transaction report that supported what was going on? If there's no suspicious transaction report and there is a mandatory disclosure in any event, then you need to be quite careful that you're not throwing away rights that are otherwise there. So, in summary, for any intermediary in Malaysia, you're going to be in the same position as intermediaries in Hong Kong, Singapore, elsewhere. Do you take this stuff seriously or not? So do you do anything as a result of today's talk, or you just say, okay, well, we'll see what happens? If you've got colleagues in the EU, that point's already passed. They have to do this. This will be the standard going forward, I suspect. And the real worry is if you've been involved in the promotion of an avoidance arrangement, or you're concerned that maybe some of your employees have been involved in that, what should you do in the meantime? What protocols should you try and enforce in the office? So do you take it seriously or not? That's going to be a key consideration for everybody involved in advising clients, particularly when you advise on CRS. The file reviews on whether or not you're a promoter or a service provider is going to be, I think, quite painful because it's very, very fine distinction between designing a scheme and advising in relation to a scheme. Now, where there is a disclosure, and you've got a number of intermediaries that were involved in it, a number of fiduciary companies, a bank, who's going to lead on that? And should we involve the client? Generally, the advice is don't involve the client in putting together your disclosure notice. It will compromise you potentially. Consider whether there's any regulatory disclosures. Here it's really about, is there underlying money laundering or any type of financial crime that you've not notified the authorities about, which a mandatory disclosure would obviously make quite plain. In terms of employees, what do you do if you have an employee that's been involved in effectively promoting avoidance for many years? It's going to be a struggle for financial institutions as to whether or not that employee has breached their employment contract and should be terminated, not least because of the reputational risks to the financial institution. Should we have a disclosure notice to the clients? I think it's important to communicate with the clients as to what is about to unfold, what types of conversations could give rise to a disclosure to the tax authorities so that they are aware also of their, the sort of legal remit within which they can communicate with you. And finally, education. I think education is going to be key. It's key with CRS, and I know that in this jurisdiction we've got patchwork approach on people's awareness of the CRS. This is even worse, right? But these are all initiatives that are coming, and the one that's worrying about this one is the stuff that you're doing now could potentially be subject to later disclosure. So you really need to know, if you're involved in financial services, particularly if you're advising clients at all on CRS, you really have to understand what you're doing. Yeah, if you're not involved in CRS sort of advice, etc., then this is okay, it's just academic. But if you are, this is quite serious. Okay, I think we'll leave it there for the moment. Thank you very much for listening. I think I've probably overrun tremendously on this, but as I say, we'll move on to the next topic. Anyone has any queries, you're happy to email me or to discuss with me after. Okay, thank you very much.